Hey gang, it's Dave Littlejohn, and I am coming to you from our Salem office today and here to answer the very critical question, have I been hiding under my desk? And the answer is, well, yeah, of course. Have you looked out there lately? In all seriousness, the markets are pretty crazy. I'm going to spend a couple of minutes hopefully giving you some perspective on what's going on with the markets, what we're attempting to do as your investment team. And I'm going to cut away from the video and you're going to hear some voiceover, and I'm going to show you some things on screen. So let's see how video magic works. The first thing I want to do is talk about the price to earnings ratio. Think about this as how much earnings a company makes for its share price. And the higher the ratio, the more money you're paying as an investor for that investor dollar earned. What you can see is in 2020, we found ourselves dropping pretty low in the middle of the COVID pandemic when it first hit, all the way down below 17. And then we saw the earnings multiples skyrocket all the way up here to over 46. This is for the S&P 500, by the way, so the 500 largest companies. Since the peak values that we saw near the July mark in 2021, we've seen those values come down and down and down. Now, a lot of this has happened with the Federal Reserve suggesting they're going to start raising interest rates and reducing quantitative easing, which means money costs more to borrow, and so the leverage started coming out of the financial system. Well, corporate earnings have continued to expand even though those multiples have declined. What we saw later is stock prices peaked in December or January, and then we've seen them fall all year. But relative to what we've seen historically, the value of what the investor is paying per dollar is a lot lower than it's been in a long time. So maybe there's more damage for this market, but relatively speaking, PE ratios are a lot more in line. The question is, are we going to see more of a recessionary environment in the future, a stagflation environment, or somewhere where corporate earnings are going to decline and then these lower multiples would imply lower stock values? Or are we going to see the continued inflationary environment where corporate earnings go up and these lower multiples with those higher corporate earnings lead to still higher stock prices? It's not determined yet, but I think it's very interesting to see that stocks, relatively speaking, don't look nearly as expensive as they did even a few months ago. Of course, prices are down significantly, but when people are saying, hey, what if they're going to fall a lot more from here? Maybe not, if we consider that the stock market tends to be a leading indicator. It's not the economy. The economy often lags the stock market. So the stock market may be forecasting what to expect in the economy, and it could be ahead of that trend already. I'd also like to point out that in the long run, this isn't that significant. I realize that everybody's now measuring off of a high water mark. We saw very peak values at the end of 2022 after a really big expansion. And when we consider how far down the markets dipped, it was certainly a spectacular recovery in the midst of a pandemic. Now, we now know that there was a lot of money printing, there was a lot of stimulus, and so that led to a lot of that market activity. And it's, in a sense, we've all been wondering, when would we pay the bill? This has been compounded by things like the war in Ukraine. It's been compounded by the disruption in supply chains, like China, for example, and a lot of the product that they supply. We know we have shortages in things like chip manufacturing that goes into many of the things that we utilize here at home. So all of this is contributing to inflation. Okay, as that occurs, we've watched as the markets first faltered, rallied, and then faltered again. But I would like to just remind you, this is since 2020, but as we look back in history, the markets have gone up and up and up. And what I'm going to do is give you a sense of not days at a time here, but weeks at a time. This is back in the 2000 move down. Then we moved up, and then the 2008 moved down. This has been a massive expansion. Some pullback is normal, typical, but relatively speaking, we're quite contained. The difference between what I would suggest we had in 2000 or 2008 is that we have a much more transparent Federal Reserve that's telling the markets what it's attempting to do. So that's not to say there's not more downside, but relatively speaking, the trend is very, very clear, very, very positive. So what I want to encourage everybody to do is take a deep breath and just remember that investing in the short term is speculation, but in the long term, statistically and historically, it has played out for the patient. So just take a breath and relax, and we'll get through this together. I'm not suggesting it's pretty. I realize life is expensive and it's not terribly fun right now. Behind the scenes, we are working on ways to take advantage of what we have to offer in this market. That can mean for some of you that if we have temporary losses in accounts, we may intentionally sell those losses, bank them, and use them to affect future taxes. It can also mean that we may take an opportunity to reposition and sell one thing to purchase something else that we think is in a better position to respond to a recovery in the markets. Okay. Some of this is going to be a work in progress, but largely we don't want to try to overtime this market. We don't want to start trying to jump in and jump out when that's statistically very, very difficult to successfully do. Instead, we want to maintain discipline, high probability moves, and we want to try to take advantage of what the market offers us. As always, if there's something specific that you're concerned about, please don't hesitate to reach out to us. Several of you have sent me emails. I'm doing my best to keep up with those and get back to you, but you can also call. We're here. I joke, we're not really hiding under our desk. We're working hard to try to make the best out of this situation. If you're really bothered by this, we often make this recommendation. This is why we talk about risk profiles and making sure that we're aligned with the risk you're willing to take as an investor. Sometimes when we go through these very real tests in the markets, it can make us reevaluate the type of risk that we're willing to take. I'm going to suggest that nobody react on emotions right now. Those tend to be the worst way to do this. So if you're concerned, please call us and we'll schedule some time to sit down together or talk on the phone or whatever we need to do. But we're here, we're paying attention, and we're doing the best we can with this. It is a weird deal. There's no way around it. But hey, we'll do the best we can. So thank you as always for putting your trust in our firm, and I'll look forward to catching up with you real soon. Take care, everybody.